2608. Look, I think gold is acting very, very strong. I read an article that the Chinese have been buying up a lot of gold recently. They're not talking about Bitcoin. They're buying real gold, and they've been buying a lot more than they've been letting on. I know there were some rumors, the Chinese don't want to buy gold now that Trump is there threatening them with tariffs. You know what? That means they want to buy even more gold. Whatever the U.S. doesn't want them to do, that's exactly what they're going to do. So take advantage of the weakness in gold. Silver also got hit. It's back below $30 right now. It's at $29.50. I don't think it's going to stay below 30. Again, I think this is where the support is in silver.
Gold prices have experienced significant volatility in recent market developments, particularly following the Federal Reserve's latest policy announcement. Peter Schiff, the renowned economist and CEO of Euro-Pacific Capital, noted that while gold initially dropped by approximately $60 per ounce, it demonstrated resilience by rebounding $30 to reach $2,612 after briefly dipping below $2,600 at the close of trading. Federal Reserve Chair Jerome Powell's recent comments have heavily influenced the precious metals price movements. Following the central bank's decision to implement interest rate cuts, Powell's less dovish forward guidance triggered a sharp decline in gold prices, with gold falling over 2.28% below the $2,600 mark. The Fed's more cautious stance stems from ongoing concerns about inflation, with Powell emphasizing the necessity for prudent monetary policy. The central bank projects that inflation will take 1 to 2 years to return to its targeted 2% level, indicating a more gradual approach to price stabilization than previously anticipated. An exciting trend has emerged in the relationship between gold prices and mining stocks. Schiff pointed out a significant divergence from historical trends, where gold stocks usually outpaced the metal, particularly before Donald Trump's presidency. Despite gold being just 7% below its recent peak, major miners like Barrick Gold and Newmont Mining have seen their stocks drop 35% and 33% respectively from their highs. The underperformance of gold-related investments appears to align with historical trends during U.S. presidential election periods, where gold typically shows weaker performance compared to its long-term average. As of December 2024, while Barrick Gold has been identified as one of the top 10 undervalued stocks in the basic materials sector on the Toronto Stock Exchange, increasing operational costs have hampered the company's ability to capitalize on higher gold prices. Similarly, Newmont Corporation faced significant challenges in the previous month, with its shares declining by 15%, according to S&P Global Market Intelligence. This reflects broader industry struggles despite the generally favorable price environment for gold. Before we get started, don't forget to subscribe, hit the bell icon for notifications, and share this video with your friends.
Everything was down except the dollar. Gold was down about $60 an ounce today. It's up about $10. Now it's up $30. I don't know. So now it's back above 2,600. It's just regained. I don't know what just happened. I looked at the price of gold 10 minutes ago, and it was up $10. Now it's up $30. So it's regained half of the $60 loss already. So we're back above 2,600 at 2,612, but we were down below 2,600 when trading closed. But what's amazing? The gold stocks, again, got absolutely hammered today, right? Barrick Gold was down 4.5%. I'm giving you the big ones. Newmont Mining was down 5.5%. This is how ridiculous it is. So gold, before this $30 rally, because I looked at the numbers before this rally. So before this $30 rally that we're having right now, gold was down about 7% from its peak, about $200. That's it. I mean, right now it's down less than $200 from the peak, but that's 7%. If you look at Newmont Mining and Barrick Gold, Barrick Gold is down 13% year to date. 13%. Newmont is down 8%. Gold is up 25%. I've never seen a year like this. 25% increase in the price of gold. Yeah, it's not the 30% that it was, earlier, but 25% up is a hell of a year. One of the best years for gold. And these stocks are down. Now, it wasn't too long ago, before Trump was elected, the gold stocks were up more than gold. Now, they weren't up a lot more like they should have been, but they were up more. But since their peaks, even though gold is only off 7%, as of earlier today, Barrick Gold is 35% below its high. 35%. Newmont Mining is down 33%. These stocks are trading at less than 12 times earnings. So what does that tell you? About the sentiment. They're less than half of the market multiple. The fact that these stocks are down so much shows you how negative the sentiment is in gold. But how negative the sentiment is in gold, that's how positive it is in everything else, right? Because it's the mirror image. You have crazy optimism on the overall stock market, ridiculous optimism in Bitcoin, but extreme bearishness, extreme pessimism in gold.
Peter Schiff explained that Federal Reserve Chair Jerome Powell and the Fed have revealed a more conservative outlook for interest rate cuts in 2025 than markets had previously anticipated. The initial market expectation of 4 rate cuts in 2025 has been revised downward to 2 or 3 cuts, reflecting a more cautious approach to monetary policy. At Wednesday's meeting, the Federal Reserve marked this shift by implementing its third and final rate cut of 2024. With inflation showing persistent trends and economic indicators remaining resilient, the Fed has adjusted its forecast, reducing the expected number of reductions in 2025 from 4 to just 2. According to Powell and the Federal Reserve's latest projections, the central bank aims to reduce interest rates to approximately 3.9% by the end of 2025, with additional cuts planned for 2026 and 2027. Fed officials are now navigating a critical transition phase, having already lowered rates to around 4.4% from their peak of 5.3%. While acknowledging the need for further rate reductions, they remain vigilant about not cutting rates too aggressively, as such actions could potentially reignite inflationary pressures in the economy. Let's get back to the video.
One of the things that Powell indicated was that, or the Fed, not just Powell, that there will be fewer rate cuts in 2025 than the markets anticipated. I think prior to today's announcement, the markets were expecting 4 rate cuts in 2025. And I think the markets had already adjusted that down to maybe 2 to 3. So one of them they kind of took off the table. So people were expecting a hawkish cut today, in that the Fed was going to cut rates, but simultaneously indicate that it wasn't going to cut as much as it had thought before. But I guess the markets hadn't fully priced in or considered what that means, because this whole stock market rally has been predicated really on lower rates, and the idea that this new easing cycle is going to propel the market higher, just like prior easing cycles. And I've known that there was going to be a lot of bumps on this road, because I knew that the Fed was not making the progress on inflation that it had believed, or that it was claimed that it was having. And I think this was reality setting in when Powell talked about how inflation had picked up, how inflation was higher than the Fed had hoped or had anticipated, that it's taking longer to get inflation down to 2%. In fact, he said in the Q&A that he thinks it may take 1 or maybe 2 more years before inflation goes down to 2%. Now, I don't think it's going down to 2% at all in 2 years. So it's going to be a long wait. But if the Fed is going to have to wait 2 years to get inflation back down to 2%, well, it's going to have to be higher for longer than the markets expected. In fact, Powell even indicated that the neutral rate, the rate that the Federal Reserve believes is neutral for the economy, not stimulative, but not restrictive. They notched that up from maybe 2.8, 2.9% to 3%. And so that also means that there's fewer cuts necessary, maybe 1 less cut, to get down to where the Fed considers policy to be neutral. Now, the Fed did say that they still think they're well into restrictive territory. They lowered interest rates now down to 4.25, 4.5. So we're now a full 100 basis points lower than the peak. Although, despite this 100 basis point rate cut, the yield on the 10-year Treasury, which closed above 4.5 today, is now better than 80 basis points higher than it was when the Fed started to cut. So the Fed went down 100, but the market went up 80 on the 10-year, and even a little bit more on the 30-year. This hasn't happened in recent times, where the Fed has been cutting and the market has been moving in the other direction. And this shows that the markets are not believing the Fed to a degree. They're concerned about the growing deficits.
Gold's performance is closely tied to economic stability and central bank policies. With inflation remaining persistent and rate cuts expected to be slower than anticipated, the gold outlook remains uncertain. Shifts in monetary policy, inflationary pressures, and market sentiment will continue to influence the price of gold, ultimately determining its trajectory in the coming months. Given the recent economic shifts, what do you think the future holds for gold prices? Share your thoughts and predictions in the comments below. We'd love to hear from you. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon to stay updated on our latest content. Thanks for watching.